DBS, UOB, and OCBC had a fantastic 2023, with their net profits all rising to record levels. Okay, UOB had a lower net profit in the latest quarter, but that was due to an acquisition. All three banks are now giving a rather fantastic 5 to 6% dividend yield. However, despite all that, all three bank stocks haven't been doing so well this year, with the best performer being UOB, which just gave a pretty meh 4.7% year-to-date return. So, in this video, we'll be going through the three banks to explain what is going on, what can we expect going forward, and as a bonus, I will also share which bank that I like the most. Non-financial advice, of course. Also, do join my Telegram chat group to discuss or ask any questions that you may have. Alright, let's jump right in. To understand what's going on, the first two numbers that we can look at are the revenue and net profit. For DBS, while its revenue has been going up, we can see that the growth has started to slow down in the past few quarters, whereas things aren't looking too good for UOB and OCBC, as the revenue has already peaked in the second quarter of 2023 and have even started to come down a little. Then, if you look at the net profit, for all three banks, the net profits have started to decline in the recent quarters.
But why is that happening?
The first reason is due to the net interest margin.
Huh? What's that?
To put it simply, net interest margin is the amount of interest that the bank earns from loans versus the interest that the bank is paying to depositors. This number is important because net interest margin is usually the main income of a bank's business, where the bank will lend out depositors' money to earn a steady PP income. What we can see is that in 2022, the net interest margins have increased for every quarter for the three banks. This is due to the rise in interest rates, and when old loans mature, borrowers are renewing their loans at a higher rate. However, in recent quarters, the net interest margins for the three banks have either started to peak or have been declining. This corresponds to the US federal funds rate, where we are almost near the peak of the rate hike cycle, and according to estimates, we may even start to see a rate cut as early as May 2024. The other reason is due to loan growth. Basically, the more money that the bank can lend out, the more interest that they can earn. Loan growths for all three banks have also peaked and have not changed much since a few quarters ago. This is simply because when interest rates go up, the cost of borrowing becomes expensive, and as a result, businesses may not want to borrow as much money. So when we combine the peaking of both net interest margins and loan growths, this explains why bank stocks haven't been doing so well. Plus, investors are also expecting banks to not do so well once interest rates eventually go down. However, this is not to say that the three banks will definitely boom and crash when rates go down. That's because 1. All three banks keep a large amount of capital with them, so that in the event of crisis, they will have enough money to tahan the losses. The term for this is called Common Equity Tier 1. In this case, you can see that all three banks have a rather high CET1, with OCBC at 14.8%, followed by DBS at 14.1% and UOB at 13%. 2. Despite a slowing economy, all three banks have a healthy non-performing loans ratio. Non-performing loans just means that the bank considers that the borrower is unlikely to repay the loan. As you can see here, the non-performing loans for all three banks have been rather steady, with OCBC's NPL even going down every 1 or 2 quarters. 3. All the banks are well diversified in terms of income sources, geography, and industry. For example, you can see that for the banks, 70% of their income comes from net interest income, with the rest comes from other sources. For example, fees income contributes to around 13 to 17% of the total income. This includes fees from investment banking, wealth management, loan-related, cards, and transaction services. Then, there's also trading income. And for OCBC, it has an extra income source, where 6.4% of it comes from insurance. Next, when it comes to loans by geography, all three banks have the most amount of loans coming from Singapore, with the rest spread nicely across countries like Malaysia, Indonesia, China, and the rest of the world. Similarly, the loans are also diversified across different industries like building and construction, housing loans, financial institutions, investment and holding companies, professionals and individuals, and so on. As for expansion plans, all three banks have been acquiring businesses over the past few years. For example, just last year, DBS acquired the Citigroup consumer banking business in Taiwan. This acquisition will enable DBS to more than double its revenue from the market to over $1.3 billion. As for UOB, it also acquired Citigroup consumer banking businesses in 4 Southeast Asian countries. Once the acquisition completes by end 2023, which is like anytime now, these 4 markets are expected to provide a $1 billion boost to the bank's revenue on a full-year basis. Meanwhile, OCBC recently announced its plans to acquire Indonesia's Bank Commonwealth. While the acquisition is considered small, it is expected that Indonesia will be a critical contributor for driving higher returns in the future. So, which is the most attractive bank right now in terms of investments? If we look at the stock price, it does seem like DBS has consistently outperformed the other 2 banks. So let's buy DBS Hold up, because there are also other factors to consider. Check this out. If we look at this in terms of dividend yield, OCBC would be the most attractive at 6.26% yield, whereas DBS has the lowest dividend yield of 5.64%. However, this is not to say that DBS is not attractive. That's because we can also look at the return on equity and the earnings per share growth rate. For this, DBS would be the clear winner here, as it scored the highest on all 3 categories. On the other hand, both OCBC and UOB had a lower return on equity at around 14%, and OCBC earnings per share is the lowest at 53 cents, whereas UOB has the lowest earnings per share growth rate of 5.4%. This also explains why DBS has the highest price-to-book ratio, meaning it is the most expensive stock out of the 3 banks, whereas OCBC is the cheapest. Quick pause. Did you know that 1 in 4 Singapore residents uses Moomoo Singapore? If you are looking to analyze which bank stocks you can invest in, Moomoo Singapore provides a range of comprehensive research tools to help you identify investment opportunities and take control of your investments. At the stock page, tap on Company, then swipe down to see Financial Indicators, where you will find important financial indicators such as ROE, EPS, and PB ratios. You can also customize the period to fit your needs. You will see useful visualizations of financial data, such as financial estimates and revenue breakdowns. This makes complex financials easy to digest, and best of all, they are totally free to use. If you want to compare these bank stocks, you can tap on Company Valuation, Comparison, then just add the stocks that you want to compare. Moomoo provides valuation indicators, analyst indicators, and financial indicators with year-on-year and quarter-on-quarter comparisons. This will allow you to easily see the differences among the stocks and make more informed investment decisions. So, if you are interested in taking your investments to the next level, do try out Moomoo Singapore. Right now, Moomoo Singapore is also offering some very generous sign-up promotions. If you sign up using my link down below, you will get to enjoy a 5.8% per annum guaranteed returns for up to 30 days on your first 80,000 Singapore dollars invested with Moomoo Cash Plus. Additionally, you can unlock up to 4 fractional share bundles consisting of your favorite US stocks like Nvidia, Tesla, Apple, Sea, and NIO when you start investing with Moomoo Singapore. What's more, you can also get up to 20 SGD cash coupons after depositing 100 SGD and performing 1 buy trade. So that's around 680 SGD worth of welcome rewards in total. And with that being said, let's get back to the video. So would I be interested in buying Singapore bank stocks today? It depends. If I'm buying for the long term, the answer is yes. All 3 banks have good financials, have track records of paying good dividends, and the future is bright for all of them. But if I'm buying for the short term, not really. That's because with interest rates peaking and a possible recession coming soon, there's a chance that banks' earnings could drop in the near term. Like if you check the stock chart, every time there's a recession, bank stocks typically don't do well. That's because when times are bad, loan growth may decline and some borrowers may even default on their loans. But who knows, I may be wrong. After all, DBS is expecting 2023 record profit to continue through 2024 due to strong margin growth in commercial lending. Similarly, UOB is also expecting better loan and fee growth in 2024, while projecting increased loan growth and fee growth in 2024. Meanwhile, OCBC is a little hesitant in giving a good outlook. But I guess the ultimate question is, if I'm only able to just buy one bank, which bank stock would I go for? Personally, I would go for DBS, mainly because it has the best stats in many areas. Best return on equity, best earnings per share, and earnings per share growth rate. DBS has also shown that it can continue increasing its revenue as well as net income, while the other two banks have peaked. Plus, DBS has ties with Temasek while being named the world's best bank for a few years in a row. But DBS had so many outages this year and they have the highest price to book ratio. Personally, I'm not too worried about this, as MAS has imposed a 6-month pause to DBS new business ventures, which actually is a good thing as it would give DBS some time to fix its issues. As for the high price to book ratio, that's just a common thing where good stocks tend to be more expensive. A solution for that is just to dollar cost average over the long term while waiting for a chance to buy more if ever the stock goes down. But what do you think? Which bank do you like the most? Do comment down below and let me know. Also, like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.